Before the UK housing market moves, we see moves in leading indicators, and it's from these leading indicators we can predict changes in UK house prices. So, if you're thinking of buying or selling, this video is for you because we're going to track those leading indicators to see what's in store for UK house prices, but more importantly, how we can stay one step ahead of the curve. Hello and welcome back. So, those who have been following along from the start will know that we will track four indices. Those are Rightmove Nationwide, HM Land Registry, that we also call the official data, and Halifax House Price Index. So, first up, let's take a look at Rightmove, which is an asking price index. Now, this gets some stick for just being asking prices, not sold prices. However, I see it as a fantastic indicator for kind of market buoyancy, I guess. And it's actually great because they cover such a breadth of the UK. A huge market share that they have means a huge amount of data that comes with that. So for the month of November and December, 359,000 and change. That's a move down at 2.1% on the month, but still showing 5.6% year over year growth. So that is from December of 2021 to December of 2022. Next up then above that is Nationwide, and we've the latest data set here for the period of December. So that's showing 262,000 and change. Now, again, another move, a month-on-month move down at 0.1%. So very nearly flat, but still showing a negative month-on-month decrease. And annual change, i.e. again from December of 21 to December of 22 at 2.8%. And just to reiterate, these are nominal prices, so 2.8% over the year when we know what inflation is. So house prices, according to Nationwide, haven't fared too well when compared to inflation, i.e. an inflation-adjusted loss. Now, we're going to come on to that further in the video series where we look at the Nationwide house price index adjusted for inflation, for that RPI inflation figure, and the move, as we expected, has gone south. But we're going to come on to that in slightly more detail in a little bit. So next up then, HM Land Registry, also called the official data, or called the official data, certainly in this video series. It uses sold prices. Again, it's lagging, so we've got it for the month of October, and it's £296,422. It is still showing a month-on-month increase at 0.3%. Bear in mind that's for the month of October, and it's still showing year-over-year annual change at 12.6%. But I will just very quickly point out this figure here, 0.7%. It's the report from the Office for National Statistics, or the ONS, and it actually uses the data from HM Land Registry, but they make one key difference. For the month-on-month change, they have a seasonally adjusted figure. So the seasonally adjusted month-on-month move for October from the ONS was 0.7%. And of course, being so lagging, we quite often call the official data the laggard of the group. Okay, last but not least then, the Halifax House Price Index, again covering for the period of December, 281,000 and change, down a month-on-month move at 1.5%, but still showing annual change at 2%. Derived again in a very similar way to the Nationwide House Price Index, and that they're both produced or derived from their own mortgage lending data. Okay, bit of a mixed bag there. So let's have a brief sit rep. So we can know that the HM Land Registry is lagging, and so this data kind of splits the group a little bit, still showing growth, month-on-month growth for the month of October. Our more timely and slightly more coincidental indicators in Rightmove, Nationwide, and Halifax are all showing decreases. Now, this isn't the first time they've shown decreases. In fact, both Halifax and Nationwide, this is the fourth month-on-month fall that we've seen from both indices. But I want to pose a very quick question here. Why do we bother looking at prices if we've said they're lagging and coincidental in a video series which is about leading indicators, i.e. data that moves before house prices, so that we can get out in front of prices? And the answer, I hope, is glaringly obvious. In all the data that we've reviewed throughout the dashboard data dump in the next tab that we're going to come on to, of course, we're looking to get out in front of house prices. But if we don't come back and explore what's happened to house prices and see whether our bias was correct or not over a certain period or longer, then what's the point? We have to come back and check that we're on course. There's a great saying, there's lies, there's damn lies, and then there's statistics. It might not be that we were flat out wrong, but something in our bias and how we're using the data could be slightly off course, and in an attempt to correct it so that we can be much more accurate in predicting house prices forward looking. That is the absolute essence of why I make these videos. It's not because I want to become a YouTuber. In fact, I make the claim I'm not a YouTuber. It's not for clicks and likes. It's that we can examine data together in an attempt to get out in front of the UK housing market and predict those prices with a very high degree of accuracy. So in short, we always want to be coming back to prices to confirm or deny our bias built in previous quarters or years. Enough talking, let's dive into the data. Let's dive into our dashboard of leading indicators. And first up, we're going to take a look at mortgage approvals, which are a fantastic leading indicator for future borrowing. In January, we get the data set released for November, and that figure is here. I'm just going to highlight that for anyone watching along. So you can see the figures 46,075, a massive nosedive from the October figure as well, and another month-on-month fall. Certainly not bullish for the UK housing market, and certainly not then for prices. You can see it in the graph here plotted against year-over-year house prices, and that is the official data from the Land Registry, so it is slightly lagging somewhat. So if we go ahead and jump to the chart where we can see it plotted against the nationwide data, and we've taken it all the way back to 1993, again both nominal, so the previous chart was nominal figures from the Land Registry, and this is percentage change again, but using nationwide. So a very tight grouping as we've been through and explored in previous videos. And again, I haven't lagged this, so you'll see these peaks are slightly offset. And I've just wanted to keep that as organic as possible. Also, things to note are such as the bottoming out here in November of 2008, and of course we saw prices bottom nominally again in March of 2009, several months later. So as we've examined in previous videos, we can see this high here in mortgage approval numbers, and we're now down 56.98% from that high, a significant number. And just as an FYI, to compare to the last crash, the GFC in 2008, we saw a peak at 126,282, and that trough that we covered before at 26,347. So that was a fall in percentage terms of 79.13%. So if house prices are going to fall like they were in 2008, or certainly mortgage approvals are continuing to fall like we saw in 2008, there could be more to come. In previous videos, I've gone back through and dug out the last 15, sometimes 20 years worth of data, but for a specific, just isolating one specific month. And it was very, very telling. And I've done the same thing again in that tab below called Jan Data. Now, before I do, I want to just pose a very quick question. Which do you think is the worst month statistically for house price data? Is it January or December? So January, everyone's coming back fresh with fresh ideas, fresh plans, possibly got their house up for sale or going to put it up for sale. But December, you see that lag over Christmas, that slowing down where people are less interested, but then in that time off from work, also scouring Rightmove for any fresh properties that have hit the market. Well, let's go through together and top this up. So we've one red, two, three, one green, 4, 5, 6, 7, 8, 9, 10, 11, 12, second green, 13, third green, 14, 15, 16, and the last one being green. So we've 4 greens and 16 red month-on-month moves where house prices have moved down in January. In fact, January is an appalling month of data for house prices. So what then can we infer? Well, we're expecting house prices in January, in the month of January, when compared to December, to actually fall. And to answer the question I posed, is it worse than December as a month, just isolated for that month? Yeah, in fact it is. January is much worse. Have we been selective with the data? Well, of course, we've gone up to January 2020 to avoid any erroneous COVID data, and we've gone back to 2001, which gives us 20 data sets. Well, okay, from 2000 to 2020, of course, we've seen house prices go up. We've had an almost 20-year bull run. However, it has been cyclical because we've seen a cycle, and that was the 2008 blow up. So then to conclude, in January, I am expecting house prices to fall. But one thing to bear in mind is that we're not going to get this data from the Land Registry until February. We won't get this January data for 2 months after January. So the March report will in fact include January data. So we'll be able to know whether we're right or wrong in March of 2023. We're going to move on, and of course this data and the percentages is fantastic. It's fantastic at removing anecdotal evidence which surrounds the UK housing market and allows us to really isolate and pinpoint and build biases around the data, which is something that I'm really trying to push in this video series. But nobody goes and places an offer on a property or sells a property and use percentages. They don't even use real inflation adjusted data. You use nominal data. So in the next tab we're going to take a little sneak peek at what nominal prices have done throughout 2022. Right, so in this tab, we've got prices going back to January 2022, all the way up for two indices to December 2022. So for the full year 2022, in effect. So in the graph, you can see nationwide nominal house prices denoted in blue. We've got Halifax, again, nominal house prices denoted in red, and the Land Registry sold prices in this yellow or goldy colour. We've also got an asking price trend again for from Jan 2022 to December 2022, full year, and these are of course asking prices. So what can we see straight away? Well, let's start with this red line. This Halifax nominal house prices shows flat house prices throughout most of the summer from around May 2022. We do see a slight peak in August of 2022 before a subsequent decline month over month in prices to where we are at now, as we said at the start of the video, 281,262. Next up then, let's take a look at nationwide. So you see a slightly more incremental rise, but this following the same pattern. We have this same peak in August of 2022 at £273,751, then down month on month to where we are now. Again, as stated at the start of the previous video, 262,000 and change. We also see a similar-ish trend happening in asking prices from Rightmove. We see a subsequent peak here, but 2 months after the two indices of Halifax and Nationwide in October. The only outlier we have here are what we call the official figures, which are sold prices. Again, we only have data up to October of 2022, but they have been steadily increasing throughout the whole year. But as we saw in the Jan data in the previous tab, if house prices don't fall as shown by official figures in the later data release sets in November and December, then we will probably likely almost certainly see it in January. Just bear in mind though that we'll get that January data set released in March of this year. So in March of 2023, we will get the January 2023 data from the Land Registry. Okay, moving on. Next up, we're going to look at real average weekly wages. Really simple but important data set. As you can see here, when real wages increase, so do house prices. When real wages fall, so do house prices. And again, when real wages increase, we also see that run up after the GFC crash. So what's happening in the month of October? This is the latest data that we have released. It's showing £506, which is the average real, so inflation adjusted weekly earnings across England and Wales. So down again from those highs, these highs in, you can see here in April of 2021 of £525. So wages still being smashed by inflation, and as we said at the start of this segment, real average weekly earnings down is not a bullish indicator for UK house prices. So next up, we're going to look at real M4. One runs into the other because if real average weekly wages are down, then we would expect real M4, which encompasses an element of savings within it. It's that cash. We're going to get into the definition and we're going to get into this. We would expect that to also be down. And in fact, we are right. So as mentioned in the previous video, we have two versions of M4, or not two versions of M4, but we've two different data sets. So for an explanation of, or a definition of both, let's jump over to the Bank of England and get it straight from the horse's mouth. So M4 here, the definition of M4. M4 comprises of the private sector's holdings of sterling notes and coins, sterling deposits, including certificates of deposit, commercial paper, bonds, FRNs, and other instruments of up to and including 5 years original maturity issued by UKMFIs. Claims on UKMFIs arriving from repos and estimated holdings of sterling bank bills. So let's go ahead and compare that to retail M4, often called M2 in Europe and the US. So it's slightly narrower in that it's M4 private sector holdings of sterling notes and coins, so in the same way that just plain M4 was, and sterling denominated retail deposits with UK MFIs, so money that you and I have on deposit with banks or financial institutions, and notes and coins. So two different definitions because we have two different graphs. I don't know who watches these videos, but to keep everybody happy. And then of course, we've adjusted them for CPI, which is the Consumer Price Index. Now we're going back all the way to 1990 here. I've changed it in the last video. It was 95. We're going to go all the way back to 1990. And I know, of course, CPI wasn't the official government measure then. It was RPI. I purposely adjusted for CPI given that CPIH, Charlie Papa Indigo Hotel, already comprises a housing element within it. So to adjust for that, I thought was unfair. I know that's going to upset somebody. You've got to hang your hat somewhere. But what I hope will keep everybody happy is the fact that within these two graphs, and I've applied no bias here, I've just picked one to apply and put the other with the other. We've got M4, so by definition, that was this definition here. And we've overlaid real, so again, inflation adjusted house prices from the Land Registry. However, in the next graph, we've M4 retail, again, definition here, and we've overlaid real, again, adjusted for CPI, house prices, but from nationwide this time. So two different measures of M4, M4 and M4 retail, and two different house price indices overlaid. So hopefully if you're wearing a big cheeser from ear to ear, that's fantastic. If I've just put you to sleep, I'll try and run through this as quickly as possible. It is very, very telling. And just try and think of M4 as essentially just being the cash that you and I have. And it's quite often called the oil or the grease or the liquidity that drives the gears, the whole UK housing market and the economy in wider terms. Just before we dig in, I did say we'd extended this back from the previous videos. I think the previous video was 1995. We've gone back further. There's a reason for that because the 1989 house price crash, we can see this dramatic fall in M4 indicated in this first graph, in this top graph. Now, unfortunately, we don't have house prices there because the Land Registry doesn't give us the data going back that far. Although we can do this with Nationwide, it does go back slightly further. I just wanted these two to marry up so there was no indication of any bias here so that they look the same and we could talk about the same period. Now we've ran through this before in previous videos, so we're just going to give this a very quick overview, but the beauty of graphs, if you're a visual learner, it's very easy to spot trends. So of course, as noted, we've got the 1989 house price crash here, where we saw M4 plummet. We've then got several years of growth where, of course, the 2008 blow up, the GFC hits us. We see house prices then adjust and then we see them slowly but surely rise back up to what could have been a massive peak or what could be a massive peak around COVID time. And of course, then M4 plummets again. So question, does a plummeting M4 always mean house prices are going south? Not always, but typically when they have gone negative, we've always seen some kind of above average 2-3 standard deviation move in prices. So that's exactly what we're expecting as we detailed in the previous video. So let's scroll down and look at graph number 2, or the bottom graph. This, as explained, was M4 retail plotted with real nationwide house prices. So M4 retail is on the left, shown in blue, again, both in percentage terms. That index is blue, and the red is the prices or the percentage change in prices from nationwide, and that is plotted on the right hand axis. And the change between last month and this month with the freshly updated data is, in fact, it's fallen even further. So a falling real M4 figure or a negative M4 retail growth figure is in fact forward looking, and so therefore we can expect house prices to further fall. Okay, we've seen a lot of data so far. Let's just have a little sit rep. Well, to finish off M4, we of course know it's extremely tiny, whilst a little bit volatile and erratic. We can see in this top graph 1989 crash, the 2008 blow up, and what we suspect is likely to be something similar. There is actually another data series that I do have, which is liquidity outside of M4, because what M4 does not encompass is other things that we might class as wealth, such as, and not limited to, money that we have in a pension, private or otherwise, money that we might have in a trading or an investment account, and of course, potential paper gains that we have within equity in our homes. Before we push into our sentiment indexes, both our UK sentiment index by GfK and of course the RICS data, the Royal Institute for Chartered Surveyors, which is a fantastic and timely indicator of supply and demand. Supply and demand, of course, pretty much underpinning prices for the first 2/3 of 2022 at least. And then we'll jump back into the spreadsheet. We'll do rates, of course, which are fantastic for affordability, and what I think is slightly more telling, which is the 5-year mortgage spread. Let's just jump back into mortgage approvals and we'll go from there. So to recap, mortgage approvals, which are a fantastic leading indicator for prices themselves, are down. They're down off peak 56.98%. Now, in comparison to the 2008 GFC, they fell 79.13%. So potentially, if we do see something like the '08 blow up, there's more to see in terms of price correction coming. Moving swiftly along then to the Jan data, as we previously said, January, a not fantastic month for month-on-month moves in prices themselves. And moving into nominal house price data, went back to January of 2022 and pretty much mapped out the full year where we had the data for, and it showed a peak in 2 of the 4 indices in August of 2022. M4, which we've most recently examined, a further falling figure like we've seen across our dashboard of leading indicators, indicating further falls are expected in house prices to come. So this is the GfK Consumer Confidence Barometer, a tried and tested method of measuring sentiment right across the UK. In fact, it's used by government and government departments. So this is the data set we have for December, and although we've seen this bottoming out here potentially in September of 2022, where we saw a reading of -49, then in the subsequent month in October, -47, November -44, and December -42, it does still mark the 8th successive month this is below a reading of 40, which is the first time this has ever happened in 50 years. So whilst that is historically a very, very low reading, we might have actually seen the bottom, the troughing out of this confidence barometer. And in fact, this is shown across the board in other graphs. We can see it here, specifically forward looking for the next 12 months in the sentiment of the personal financial situation of households. We can also see it here again in the forward looking general economic situation of the country. And last but not least, we can also see it in the consumer confidence barometer, personal finances, again forward looking, and again that general economic situation, again forward looking. This could have bottomed. A very important metric and something we're going to have to keep our eye on very closely then, because the way we feel, i.e. our sentiment, of course affects the actions that we take. It's almost a prerequisite to anything we do. It's the way we feel about something before we potentially do it. Next up, we're going to take a look at the UK Residential Market Survey, which is produced by RICS, or the Royal Institute for Chartered Surveyors. The reason we use this is it's very timely and very accurate. Indeed, it's used by both Goldman Sachs, who say it's the best short-term lead indicator of house prices and activity, and the FT says one of the most reliable guides to movements in house prices. It's only right then that we should unpack all of this, and it is in fact used by other key institutions here. So what's in store for us this month? Well, let's take a look at the latest report, which is published in December, which tracks the November data, and we can see the headline here: sales market activity continues to fall, now leading to a softening in prices. Well, this is nothing new to us. If you've been following along since the first video in August, you'll know this is what I've been screaming about since then, or certainly that the data was screaming at us that some statistically large move was likely to happen. So the first headline: indicators on buyer demand, agreed sales and new instructions remain negative. National house prices begin to fall. Both price and sales expectations point to these trends being sustained over the near term. So everything that all these months ago our dashboard of leading indicators was inferring has in fact now started to happen and is playing through right across the UK property market. Now anyone can grab this, just key in Rick's UK Housing Market Survey and you'll bring this up. It is a free report. However, specifically, I wanted to pick out two key things which should help us unpack supply and demand. So for that, we want to look at new buyer inquiries, which we can read here, came in at -38 in November, marking the 7th successive negative monthly reading for this indicator. Although the latest reading is not quite as downbeat as -53% seen last month, i.e. referring to November, it still suggests momentum behind purchaser demand remains weak. Okay, new buyer demand then down, fine, that's okay, but we don't take that in isolation. We want this as a kind of ratio between demand and supply, because if we assign a unit of 10 to demand and 10 to supply, if new demand, i.e. demand, came in at lower than 10 and we said it's 8, but in fact supply also dropped from 10 to 8, they are still paired. There's been no skewing in that ratio between supply and demand, and that's exactly what we're looking for. But just before we go on, I don't know who's been watching this from the start and whether this point has been missed. Whilst this is a very accurate data set that encompasses lots of data from right across the UK, there is a kind of caveat. It is still a sentiment-based index. This is the thoughts and feelings of everyone surveyed or polled that is part of the RICS membership. In fact, we can see this stated clearly here in the methodology. The other thing I must draw your attention to, which I know we've talked about in the past, is net balance data and how net balance is calculated. Well, as stated here, proportion of respondents reporting a rise in prices minus those reporting a fall. If 30% reported a rise and 5% reported a fall, the net balance would be 25%, i.e. 5 minus from that 30. The reason I mention this is just so we can stay mindful about how and why this data is reported. Okay, next up, we've looked at demand. Let's check out supply. So a decent metric of supply here being new vendor instructions. And we can see in the last part of this graph, it remaining relatively flat for the past few months. If we are to see price falls, then what we would expect to see, again as a percentage when compared to demand, would be new vendor instructions to remain flat or to increase, i.e. the number of properties coming to market that are for sale would slightly increase compared to that demand figure. In essence, demand down, supply up. So next we're going to go over and take a look at our spreadsheet. We're going to head back there and take a look at our last two remaining tabs before jumping into market expectations for inflation, as that is the clear standout number one reason of raising rates. So rates to date into households looking something like this. If we click over on the chart button, you can see a slight bit of respite for the first time in many months. Rates and mortgage interest rates finally having some respite, having just hockey sticked from this low somewhere around the back end of 2021. Whether this is just a brief respite or whether we have in fact seen them peak will remain to be seen, but there are an estimated 1.8 million households that are going to need to remortgage, that come off a fixed rate in 2023. And of course, if that rate is much, much higher than the one that was previously locked in, it doesn't take a genius to work out what's going to happen to affordability. Last, then, and by seriously no means least, we're going to take a look at the 5-year mortgage spread. Now, the 5-year mortgage spread is simply the difference between the 5-year government bond yield and the 5-year fixed mortgage rate. Why the 5-year fixed mortgage rate is interesting is that, well, according to Zoopla, 6 in 10 mortgages are a 5-year fix. And I guess the second reason is because any fixed rate mortgage is priced from the swap rate, with the Bank of England base rate more influencing variable mortgage rates. And we can compare all those things to the risk-free 5-year government bond yield. So what's happened in the last month? Well, you can see the spread actually decreasing slightly, even though we have seen the 5-year bond move slightly north between the month of November and December. And we have actually seen the 5-year fixed rate mortgage move ever so slightly down. So in essence, we've seen the 5-year mortgage rate drop faster or more than the increase in the 5-year bond rate, which has meant we can see this drop on the graph. And although volatile, we can still see that the spread is up off those 2021 lows, indicating increasing stress in the housing market and an increased level of housing market stress still yet to come. So whilst fixed rate mortgages are more influenced by the swap rate and variable mortgage are more influenced by the Bank of England bank rate, the interest rate set by the MPC, it's also interesting to take a look at inflation expectations, as the Bank of England is very clear with their mandate. The reason for hiking bank rate is to combat inflation. So as in previous videos, it's pretty poignant to take a look at the UK instantaneous implied inflation forward curve. Now, why would we do this? Well, this is the market expectations for UK inflation. Now, why is that relevant? Well, the MPC uses this as a reference in order to make a decision on whether they should hold, hike, or lower bank rate, because a hiking of bank rate eats into the affordability, which is then reflected in prices. So if we can use this implied inflation forward curve as a way to attempt to get ahead and see what the market expectation is for inflation in the UK, we'll be one step ahead. And for the first time in a long time, we can see this marked change in the front end or the short end of the curve. And for example, if the inflation expectation is that it will fall faster than expected, this could influence further decisions made by the MPC. Those are the guys and girls that make the decision about bank rate, and no or further hikes will of course influence affordability in pricing. And that brings us nicely to the end of the video. Thank you so much for watching. There'll be another video in 2 or 3 weeks' time. We have a fresh set of data to unpack. I'll see you then.